Good afternoon. Welcome to the Forex Pro Charts weekly analysis for the week of February the 6th, 2011. This week we will be examining the Great British Pound US dollar pair. Let's go ahead and take a look at the monthly chart. Okay, and as we take a look at the monthly chart for the GBP USD, or the GU, we can see that for the last 1, 2, 3, 4, 5 months, basically price has been stopped here at this monthly armpit, monthly resistance armpit. The monthly resistance armpit is this thick black dotted line, and the area between the monthly armpit and the solid black upper edge of our trading field, which represents recent monthly highs. This is the area that we would be most likely to see price make a long-term reversal. Very often these armpits, the monthly and the weekly armpits will act as a resistance or a support if they're on the support end, lower end of the trading field. And that's basically what's happening in this case. We can see that price has come up and hit this monthly armpit, bounced down to the support zone that was formed, come back up, bounced back down, come back up, and now we're looking to see whether price will again bounce back down to this support or even lower, or whether it will break through. You can see that we've got the extended monthly trend wall here, and it is right at the monthly armpit, and so we are waiting to see whether price will move up and break through or whether it will continue down. And of course we have actually a couple of stacked resistance zones here that we'll look at in a little bit more detail. Since price had hit the upper edge of the trading field, it was trending down. The EMA still shows the overall trend to be down, but you can see here we came within this area. Price bounced basically right off the weekly armpit and then continued a long-term trend up. We would really look to see price move up into this area before it actually reverses again, but it could reverse off of this monthly armpit. Let's take a look at the weekly charts and see what we can tell there. Okay, so as we take a look at the weekly chart, we can see that action a little bit better. We see where price came up here and touched up against this this upper edge of the trading field, or the zone there. Actually, the zone originated there. Price almost touched right there and then moved on back down, then came back up, and here is it. Here is where you see it doing the bouncing in between. So this is what we've been seeing again for the last several weeks, is that price bounces off of this, moves down, and now has bounced back up and retraced just a little bit at the end of the week. So again, we're looking to see whether price will continue back down to this support zone or whether it will move back up and through. This is the first revisit to the zone, and even though we have stacked zones here, this did not quite touch this zone, but really you're kind of looking at the same area. Here would be your first revisit to this area. It just missed it, bouncing off of the monthly armpit, came back down, and now bounced again. So if you're really trying to be conservative, you might consider this the second revisit to this set of stacked zones right here. And again, if price moves back down, it'll be the second revisit to this support zone, which again is the first of 3 stacked zones. So taking a look for trading, you can see that price did take a nice bounce off the 60-minute armpit. When it hit here, it retraced back. We'll take a look at that in a little bit more detail on the hourly chart. You can see that both this bottom and second and top stacked zones have the pattern that we're looking for on the weekly chart. We've got the rally base drop pattern, and here you had a rally base drop pattern. You can see that in both instances on the weekly chart, price moved very strongly out of the zone. We'll want to take a look at that on the daily chart as well. But again, price moved strongly here. You've got that nice pattern, and price moved all the way down to this support zone and then back up and moved sharply up. Again, because this is probably the second revisit to this area, we might expect then at any time that price would come up through. Like I said, we would be most likely expecting price to pass this monthly armpit before it actually turns and makes its way back down to the lower edge of our trading field. And so if it comes down here, there's a good chance that price would bounce again at one of these areas. Now, as far as the pattern on the weekly chart, obviously this top zone is the strongest, because you can see that we have that strong pattern there, whereas looking at these other two zones, you can see that the origination of those zones was just in a uptrend on the weekly chart. Now we'll want to look at the daily chart to see. We may see something there that would strengthen. If either of these zones had a red painted candle at its origination, that would strengthen that zone on the daily chart. The other thing to think about on this zone here, actually all of these zones have very small risks and have good risk to reward ratios. As you get down to this bottom stacked zone, however, you can see you've got a very small risk here, but you need to keep in mind that you've got this monthly armpit directly below, and so you might be aware that price could spike through down to this monthly armpit and then back up, and you would want to consult your trading plan for how you trade that. Some traders will add a cushion and take that into account. Others will just strictly trade the zone. So that's really up to your personal preference and your risk tolerance. But we could see that happen at this level. If we do move back up and move through, we could see a bounce off of this 60-minute armpit as well. But if price does move through, I would almost expect it to go ahead and move up towards this zone. Now, again, you've got the same situation where you've got the weekly armpit just beyond this zone, so you will want to take, and actually I think this is a distance of about 200 pips from this 60-minute armpit to this weekly armpit. That's too much. We'll want to take a look, but again, you should be aware that price could spike through up to this weekly armpit. It strengthens in terms of looking at a long-term trend. These armpits strengthen and make it more likely that we will see a bounce, but we do on occasion have spikes go through. Now, if price goes all the way back up here, again, you had virtually a revisit here. Price came very, very close to this zone, but that has been a while, and price then continued all the way down. So when we see price come back up here, it is the upper edge of the trading field. We've not breached this level in quite some time, so we would expect to see a bounce off the 60-minute armpit and see a long-term price reversal. In addition, we could see additional resistance zones form in this area as price moves up. So we'll be watching for that. Let's go ahead and take a look at the daily chart. Okay, now we're looking at the daily chart, and we see here where price originated in this zone, and that we did have a strong red daily candle at its origination at this upper zone. You would want to go back if you have Forex Pro charts. This is a proprietary indicator that we have, and usually just makes the zone stronger when you see at the origination of a zone, when you see a long red painted candle. That's a combination of a couple of factors, including volume, and that just makes the origination of that zone stronger and makes it more likely that we'll see a nice move back then when price does revisit. So if you have Forex Pro charts, you could go back to the origination of both of these zones and see if you have that that red painted candle, and that would make the zone a little bit stronger even though you don't have the drop base rally pattern on the weekly chart. You'll have it on the daily chart, but the presence of that red candle would make one or more of these zones a little bit stronger and might determine where you choose to place your trade or which zone you choose to trade. Let's see. Coming back up, we can see, we're going to take a look at this price action. We can see that price came up, hit the 60-minute armpit, actually also hit the 5-minute armpit and this monthly armpit, and bounced again. So we're going to take a look at that price action in a little bit more detail on our hourly chart. But again, you can see that we are basically expecting price to continue down long term, although we may see some bouncing back and forth. And as I mentioned, if you are considering this kind of all of one zone, as we do sometimes when they're stacked in terms of looking at traffic in that zone, price here almost reaching this upper zone, and then here the same thing. So you could consider this basically the third revisit to the zone. As you know, whether or not it is a first revisit to the zone, it increases the strength of our odds enhancers, and so as price moves up, that would be the third revisit to this zone, and we might see price, take a small bounce off of the 60-minute armpits and then move back up through. So those are factors that you need to keep in mind when you're trading the support and resistance zones, and as to whether or not you take the trade as you move up to the next 60-minute armpit, and you'll want to be evaluating risk along with those other types of factors. So we did have a trade on the GU this week, as you can see, as we talked about just a minute ago. So let's go ahead and pull up the hourly chart and see how we did on that trade. Okay, this was a very nice, here we're looking at the hourly chart, and this was a very nice trade this week. And depending on how you manage your trades, depended on how many pips you were able to achieve out of it. But as you can see, price came up and hit the 60-minute armpit, went just slightly past it, bounced down here. I believe this was about 30 pips down, depending on how you handle your stop. As you know, we recommend that you move your stop to break even, but we do recommend that you demo and decide for yourself whether you want to immediately move your stop to break even, or whether you want to maybe either move it in a little bit or leave it where it is for a period of time to account for this type of price action, which we see fairly often. We'll see price take that initial bounce, come back up, just touch the armpit, or just come back up to the entry point, to the entry point, and then move back down further. And you can see that price did this here. So if you came up and you just waited for price to hit the 60-minute armpit and set your limit for 20 pips before you moved your stop to break even, and took out a portion of your the first portion of your trade at 20 pips, as we recommend you do, then you would have achieved that 20 pips. But probably when price came back up here, you probably would have stopped out, depending on exactly where you entered and exactly where you placed your stop. If it did not stop you out, or if you have some kind of gradual progression to break even, maybe you move your stop to within 10 pips of your entry point to allow price to come back and just touch that entry point. Then price moved down here for somewhat over 50 pips before it came back up, moved through the 60-minute armpit, hit your 5-minute armpit, and then came back down. I believe we had 150 pips movement here. If you trade the 5-minute armpit, then you would have seen, price would have just moved nicely on down. You would have gotten actually over 150 pips from the 5-minute armpit. If you leave a portion of your trade with the stop at the original point, then you would have captured that again and moved down. But probably most traders who just trade the 60-minute armpit would have stopped out right here with a gain of about 50 pips. However, again, if not, or if you place a secondary trade at the 5-minute armpit, as many of our traders do, because the risk then very often is so small. This, I think, was only 20 pips, approximately 20 pips from this 5-minute armpit. And while the bounce off the 5-minute armpit is not quite as sure as or not quite as likely, I shouldn't say sure, because as we know in Forex, there is no such thing as a sure thing. But while it's not quite as likely as the bounce off the 60-minute armpit, it is a good high probability trade, and generally has a very low risk. So again, here, as you see, you would have been able to pick up 150 pips off of this trade. We had a number of trades this week. successful if you had only captured the minimum 20 pips off of each. I think it would have been 100 pips, and there was a maximum potential of 750 pips so far. Of course, most traders won't capture everything, but some will still have a portion of their trades open and will be able to approach that depending on how price moves in the upcoming weeks. We want to thank you for visiting us this week, for watching our video. For more information or to subscribe to our full analysis and charting services, please go to www.forexprocharts.com. If you wonder about some of the terms that we use in our videos, be watching. We'll soon be posting an introductory video that defines for you, or will show you what we mean by armpit, monthly armpit, upper edge of the trading field, trend wall, those kinds of things. And we're also going to begin this week posting videos of the results of our trades for the week, so keep an eye out for that as well. Again, you can get a free week demo at www.forexprocharts.com, which will give you a chance to sample our trade alerts and our full analysis services on 10 major currency pairs. We look forward to seeing you there. Have a great week.